Is 2024 a good time to invest in apartments? That's a question that we're going to try to answer today on the Gray Report. Looking at reports from Apartment List, CBRE, Pension Real Estate Association, RealPage, Cushman & Wakefield, Institutional Property Advisors, and CBRE. Looking at some of these short-term struggles, some of the bumps in the road and challenges, and just a lot of it's uncertainty. We just don't know. But then comparing that to some of the long-term opportunities and looking at some of construction starts, delivery timelines, and future past cap rates to see, is now a good time to get into the market, or should we stay on the sidelines? Let's break into it. If you're an active investor, passive, this is the right spot. Again, every week on the Gray Report, we're breaking down all the latest research reports and data and giving you our original opinion on what we think. Make sure you subscribe to the Gray Capital YouTube channel. You ring the bell icon so you get notifications every time we post a new video. Dr. Matt Bosnagel, Director of Communications and Marketing at Gray Capital, is joining me once again to get us kicked off. Let's get into it. All right, welcome back to the Gray Report. Matt, how you doing today?
I think I'm doing pretty good.
Good. Now that we got the mic turned on.
That's right.
So, Matt, before we get into all these reports, we've got a great list today. But first, big news for listeners of the Gray Report. Obviously, we're following this all the time. The Federal Reserve, as of May 1st, decided to keep rates steady, as it notes lack further progress on inflation. There wasn't a whole lot of, new information at the press conference today, but I did want to make sure that we covered it, touched on it first thing, and then we can get on to the multifamily specific reports. I wrote down a couple notes, Matt, just to kind of get through that I think kind of summed it up. Is again, I find most often the headlines after these speeches and press conferences are often misleading, or they don't show all of the context and often get the point wrong. And it's more of, again, think about the media, the people who are writing this. It's what headline will get the most clicks, not what a headline will communicate what the Federal Reserve is actually going to do. And so, to sum it up, before I even just start, quoting Jerome Powell, they're not raising rates. No. They're not lowering rates. We're continuing to wait and see. Again, now getting into the quotes, Jerome Powell, he says that they do believe that the current Fed funds rate is restrictive enough, that it is shown to reduce demand. The labor market is still good, but it's cooling. The housing market is still good, but it's cooling. It's more or less kind of doing the job that they would hope to do, and it is restrictive. The language that Jerome Powell used was not, well, we'll see, if we're going to have to raise it. The question, it seems to be that's the wrong question. It's how long do we need to stay in this restrictive territory? And so it's not maybe we'll have to raise rates. I don't think that's even really what they're considering. They're saying maybe we'll just have to keep rates where they are just a little bit longer. He says, they need greater confidence. They're not there yet, and the rates may stay higher longer than expected because inflation is higher than expected. But the long-term inflation prospects, which are the most important, is what is inflation going to look like in the long term, still remains well anchored. He said wage growth has eased. There's strong job creation. Well, it's still wages are still growing, but that it's eased. Okay. And so again, that wage price spiral, less of a concern. There's strong job creation, but there's a lot of new workers that are coming into the market, whether that's just younger workers that are now working, or all this immigration that we've been seeing. They're also going to reduce their security holdings, but at a slower pace than they were doing.
Oh, okay.
So they're going to be slowing that down. Again, he mentioned the path is uncertain. And again, to sum it up, he said we are unlikely to hike. He basically said, it's look, that's really not what we're looking at right now.
He's rarely that straightforward.
It was a little bit of a surprise. Now, he said it's certainly an option. They're not taking it off the table, but it's really not something that they're seriously considering right now, which is a lot different from the conversations that you hear on, the CNBCs and the Bloombergs. It's more of, maybe we just need to keep rates where they are for a little bit longer, which is what we talked about last week, Matt, of, okay, just like maybe it's not going to be this year, it's going to be more January.
Yeah, yeah.
So
no, that's a really interesting point, especially about how the discussion can kind of formulate what they think he's going to say, such that, oh, when he says it's staying the same, it's a relief because we all were talking about a rate hike. I think that I don't think that there were a lot of serious predictions of a rate hike. I think that there were people that were trying to look bold and contrarian.
Yeah, I think that's what it is.
And,
not that it's and again, just because something, something's a 20% probability, 1 in 5.
Yeah.
It's most likely not going to happen, but the fact that it's on the board, is, I guess, worthy enough or reason enough for some people to talk about it and to throw it out there. But what ends up happening is that the semi-lay person or even the investor, the market participant that is not fully read into all the minutia, just sees that headline. Yeah. And that's what they take that at face value. I don't know how many text messages I've received, after a Fed meeting saying like, it looks like the Fed's going to raise rates again. Yeah. And I'm like, well, that's not exactly what they said. Yeah, there's a strategic ambiguity that does let people fit it to whatever they want, Yeah. He did say he doesn't have full confidence at this point. Well. Yeah. But it is interesting because, on one side, we get a little bit of surprise earlier in the year that, rents are growing a little bit. Yeah. More than we thought. Yeah. And then, then should we be surprised that, oh, by the way, inflation's a little bit higher than we thought also. Yeah. Yeah. So, that all kind of lines up, taking away the way rents are calculated in CPI is that it shouldn't correlate because they should be so lagging that like we're on a whole different cycle here that we're measuring. But neither here nor there. It's like, all right, it's good that the economy is growing and that there's jobs and some prices are growing, at appropriate levels in rates. But at the same time, you kind of want the economy to be a little bit, or some market participants would like the economy to be just a little worse. So we can get those rate cuts, so then we can get our financing. But if you Federal Reserve, like, do I really care about your getting a little bit lower rate on your loan so you can refinance? What's the mandate here? I think that it's interesting to look at in a way, sometimes like scary to look at unemployment trends and how it spikes during a recession, then it goes down until there's another recession. Yeah. And sometimes though there are some shaky times where it just like hobbles along, where it's neither trending down or trending up, and that's kind of a sweet spot. But for the majority, it always seems like it's going somewhere. And right now, it does seem like employment's getting up a little. The job situation is not in a bad spot, but the trends are negative. And before, when I was, before this new hire forever Fed situation, it made me optimistic that these trends are going towards normal, maybe not going towards disaster, but now that it is pretty much baked in that we're going to have interest rates still stay elevated for longer, these worsening jobs trends, there's still now it's more of a possibility that they could continue far past what is normal. I don't think that's going to happen, but definitely I would put that on the board. It seems like the labor market is still kind of normalizing, so I'm less concerned about that. When I was writing this, what I put myself in the mind of was like, the person in 2007 that said, oh, nothing's bad's going to happen, or the person outside of Noah's Ark's boat that's like, this shower is going to pass us by. Yeah. And so, the fact that this recent kind of interest rate drama, in all of the facts that are going into it, whether it's inflation or job growth or whatever, those conditions make me a little more scared than I was previously. Sure. Yeah. No. It's what we don't see that's going to hit us, and I think certainly we're just primed for the next shoe to drop. Everyone's been primed for the last 2 years, so believe it when I see it. And that whole that bad view of the economy notwithstanding, there is a lot to be positive, to be optimistic about, especially in the multifamily market. There are a few reports that we're going to cover today that has a positive far more than just okay. Like the economy is maybe just okay, but some of these reports are actually showing some significant huge amount of confidence in the future.
For sure.
Well, let's jump into those reports. Do you want to start a baseline with where we are at the
let's start
apartment list, or do you want to go in reverse?
Oh,
okay,
it's perfect.
Let's jump in right there. Let's get the most up-to-date research on the multifamily market, at least the data on rents and occupancy, featuring, again, apartment list, national rent report for, and this is coming out in May, but this is really going to be covering, I assume, April's rents.
I wanted to put this at the top of the show because I made a prediction last month that I was wrong. I predicted that rent growth would be higher this month than last month, and it is lower, and I am wrong. And this Shane, this is the burden I carry, and I'm gonna get better, but I'm still gonna try and keep these hot takes coming. Anyways, this apartment list does make a sharp contrast with the optimistic views that I described earlier. Weaker apartment fundamentals could cripple apartment investors. So what is it about the market that is getting investors excited? You look at this, rents dropped more than they did last year. So why do you think that?
So what is the headline? So year over year, rent growth nationally, it stands at -0.8%. But what what's the month over month data?
Month over month rent growth was 0.5%, and last year it was actually 0.6%. But in April we had a stronger than in 2023 rent growth. I just think we fell off. I'm sorry. In March we had stronger. April got a little weaker. And that wasn't really in the cards according to my prediction. So it's a sad surprise.
Yeah. So, again, looking at this chart, going back to 2019, and what we're really looking at is the lift off into leasing season in the busy season. You can see that, typically, obviously the winter are the slower months, and then really starting in February, January, sometimes, a lot of times it's a negative month for rent growth. So same with December. February, things start to get going. March, April, really we're peaking typically around July or so is when we're getting the most rent growth, when the most leases are signed and the most leases are expiring. Also can be done well before the beginning of the school year. And so to your point, Matt, what we really like to see is between February and July, we'd like to see rent growth push up a little bit more and more. Last year, we basically flatlined. In April as well, we saw a strong March and a little bit of dip in April. A stronger March this year, but then a bigger drop off in this last April as well.
You said it better than me. It's a little worrying, but I think also this is a very regional story.
True.
And they note it too, how much the Sunbelt supply is affecting the national numbers.
Yeah.
Vacancies actually also, along with the dip in rent growth, vacancies are ticking up to 6.7%, and 6.8% was the previous high vacancy, which was recorded during the lockdown period of the pandemic. Again, noting these regional supply trends, the fact that more apartments were built in the Sunbelt really it can't be clear, especially if you look at the top markets for rent growth. All of the top markets in the country are outside of the Sunbelt. I think Honolulu is among the top rent growth markets, but I don't know if that technically is a Sunbelt. I would include it because it is quite sunny.
Yeah.
But that's the exception for the top rent. Now, when it comes to the bottom of the list for rent growth, all of them are in the Sunbelt except for Portland that sits at the bottom of the list.
But still, Portland in the Sunbelt, man?
Not in the Sunbelt. You get one exception for every trend, and it is supply is the story. They built a lot in Portland. They built a lot in Atlanta or Nashville or Austin or wherever these markets are with slowest year-over-year rent change. They're not because people are leaving there. Jacksonville used to be an all-star, huge amount of rent growth, and people still investors will flock to that because they see this Sunbelt story. But if you look at the numbers here, you'd be awfully sad. I still think that it's going to attract a lot of investment attention, and it's because the population's growing, the jobs are growing there. It's a great long-term story. However, the supply has been such a dominant factor in the market.
It does seem though, Matt, that in Matt we still are seeing a lot of the growth in the Northeast and the Midwest. Again, yeah, throw Honolulu or take it out, but between Providence, Rhode Island, Detroit, Cleveland, Chicago, Milwaukee, Columbus are all on those lists. And then you've got Seattle.
Yeah, these monthly changes. So they're changing on a monthly basis just quickly too.
Yeah. And then on the right, a lot of really popular markets. The slowest month-over-month rent change. I mean, again, first off, the fact that it's the slowest change, the slowest positive numbers, is a better indication than we were seeing last year. They're really seeing some growth. Obviously, it's a month where they would want to have seen some more growth. But Cincinnati is on that list. But Tucson had seen some of the strongest rent growth in the country. So the past isn't always going to be the future for a lot of these markets. But there can be a trend that is worth paying attention to say the least.
Yeah. I will make another. I'll continue to make prediction. Continue to be optimistic. I think that I'm not. I'm down but not out when it comes to being optimistic in the multifamily market. And I think that investors are getting that picture too, because there's plenty of other drivers and other reasons to kind of get excited about it. One is what I have been mentioned. I was interrupting you when you were talking about Jerome Powell's remarks, but wage growth. There was a recent report that talked about how much wage growth has increased, and people are mumbling about inflation, and they framed this wage growth news as a negative for inflation, which that's the saddest.
Well, that's the textbook response, but we're finding ourselves in just a unique environment where the textbook isn't really doing a great job in helping us define the situation we find ourselves in.
Yeah. And that's interesting. That's a good enough segue as any, because CBRE says that the past may still be prologue in multifamily markets. Use the past. Maybe we don't have a good metric or whatever, or a perfect metric, but just look at the past. That's one way to do it. I think that this is a really interesting article.
Give you a B on that transition.
Yeah, right.
There was a smooth way you could have used the past. You could have easily said, well, the past may still be prologue in the multifamily markets. That's what CBRE is indicating with their latest report, talking about future cities. Now, Matt, tell us about what CBRE is saying. What do they mean here? Past may still be prologue.
I think that their ultimate point was that there was at least they use a case study of Seattle. Now, I think that there are issues with Seattle. It's kind of interesting choice for a case study, but I do think that the point's valid. The big factors that moved the multifamily market before the pandemic are the same as those that moved the multifamily market after the pandemic. A lot of it, you could talk about supply and demand, but whether or not those are kind of correlated, which I think they are. But I think that also and the quote here is,
what is the point they're making with this?
Despite all the changes affecting the multifamily sector since 2020, historical real estate fundamentals have been a reliable predictor of rent growth. In Seattle, the same neighborhoods that underperformed on rent growth in the 2010s have continued to do so in the current decade. I think.
So are they saying basically, job growth, population growth?
I don't even think that they're saying that, or at least they have some color-coded map that shows. That's trying to make the point that it is supply and demand, that look to supply, that's going to get you to the performance of an apartment market. But I think the more fundamental point that they're making is just look at the past. Was it great in the past? It's probably going to be great. It's probably going to be great in the future. And it is a little bit more simplistic, but it is. I thought it was interesting because Seattle has had such a crazy market during the pandemic. It was an outlier.
Are they basically saying hey, Seattle's not going anywhere? This is a good place. Is that?
I kind of think that. Yeah, I think that is.
So the markets that have worked in the past are going to work in the future, which I think a lot. I think, and again, as a general statement, probably not wrong.
Yeah.
But I can give you a lot of examples of markets doing great, and now I mean, Gary, Indiana, investing in 1915, 1920, go all in. But by the Great Depression, by the time the steel, or after that, once the steel companies started leaving,
maybe 10 year time span, 20 years. I don't know how long it takes for a market to really turn around.
Now, I hear all the time, New York City, it's not going anywhere.
Yeah.
People are always going to want to be in New York City, places like New York City. it seems larger markets, I think, use that in that because it's not incorrect.
It's like low beta
it's like
market,
there's
high beta,
we're not going anywhere. But is that enough? To me, that's not enough of like a thesis of like, hey, it's not going anywhere. Okay, yeah, it's not going anywhere exactly.
Yeah.
It's not going anywhere.
Yeah, there are some like kind of stagnant, and some of them that may not have gangbusters growth. People still need to live there, so you can make a case for a market, that's not a shining star, but still needs people to live there, especially if the supply's right.
Yeah, but you can, and that's where I think you need to be really specific on the submarkets and which submarkets are growing, which demographics within those submarkets are growing.
I just thought it was interesting because
they're also being like, hey, I know this doesn't make sense to this market. Like fundamentally, you can't wrap your head around investing because we're losing population. We've got all these policies that don't work. There's a lot that can make you nervous about Washington, but. It's not going anywhere.
Yeah.
And it's
some of them you can definitely
true.
make that
But again, it's like, where exactly are you talking about? And what population am I targeting?
That's a good point. I wonder, I wonder what the timing is. How volatile is a given submarket versus a city, and which ones are now this.
And it's all local, so everything's different. There's no one.
And that's the thing that struck me about this map. Now they have it. I can't really understand this at a glance. I don't
understand most of this report.
So they color coded this according to how much supply there was and how much rent growth there was in each of these submarkets in Seattle. And what's interesting is that I don't see a huge amount of correlation. Now, if they have low, if they have low stock built, they should have high rent growth. If they have high stock built, they should have low. Now, every single one.
Not always.
I know. Not in this map either.
Not always. I mean, I guess you can oversupply, but also just because there's like new supply coming online. The reason why you build new supply is because there's demand.
Yeah.
So like the reason why you wouldn't see rent growth is because if you just happen to build too much, there's just because there's an area has demand and you're building. It's not inherent that you're going to overbuild. It often happens, near the end of a cycle.
That's what it made. That's exactly what this made me think. It wasn't. It was like, all right, it's hard to see. You can't just look at supply alone, just clearly from this map, because there are places with high supply, high rent growth. There are places with low supply, high rent growth. There are places with, any mix of these. So it's not an easy.
So is that
rule.
why they chose the title? That the past may still be prologue in multifamily markets because they were not making any conclusions. Because otherwise, they would have made a conclusion.
I think that's why I kind of came back to, well, if you can't use supply as an easy way to figure out how the performance is, I guess you got to look to the past.
It's a good title. It's not telling us a whole lot.
You know what? Maybe that it was. Maybe you start with a great headline and then.
Well, moving on from that piece, let's talk about this one from RealPage, Matt.
Yeah, the RealPage one, yeah.
MultiFamily starts plunge in March, indicating when supply wave could taper. Okay, so this is good news because we've got a 40-year peak, maybe 50-year peak in apartment supply that's going on right now. But it sounds like, Matt, we may be nearing the peak of at least starts. Is that what I hear?
Yeah. So this may be the most kind of valuable report and piece of data that we go over this time. Now, I'm not sure if I was talking before or earlier in the show, but it does look like we're approaching the end of this wave of elevated supply. It's in view. Well, it's not going to.
We're approaching the end of them starting to build the end of supply.
Let's get on to specifics for sure.
Because there's a big difference.
Yeah.
There's a big difference because this could this is the nuance. It's multifamily starts plunge, indicating waves when supply could taper,
and it's not going to happen anytime soon.
But you got to build it you have to then build the property, then you have to lease the property up.
Yep. So what we're kind of talking about is MultiFamily Starts and how they can predict how much new construction gets built later. In an earlier episode of the Gray Report from January this year, which you can check out, I'll have a link in the comments. I did a little calculating to see how we can use this data ourselves. I looked at the quarterly data for completions and for starts since 2000, and I came up with basically you can take construction starts from 2 years prior to get a good idea of deliveries today. You subtract 1% to that number for reasons, maybe the starts just didn't finish. But basically, it's 2 years is the length of time. Now, it could be a little bit longer now because of pandemic-related delays, but that average...
Pandemic-related delays?
Well, it's still working through the backlogs.
Really?
Post-pandemic-related delays.
Is it? 2024?
Well, maybe.
4 years later?
There's probably...
If I had to go back to 2020, if I went back to May of 2020 and I told myself that in May of 2024 that I'm going to be sitting here with you, Matt, talking about COVID-related delays on construction, I would be upset.
It's not wholly wrong. I mean, there is a backlog, is what is probably that they're still dealing with. Call it what you will, post-pandemic related delays or whatever.
It's hard to get some large electrical components, or at least it has been. I haven't checked recently. That's the only hold up in supply chain that I've been aware of. Okay. Other than that, now there are other. I mean, there's some infrastructure projects going on. So, labor's tight, I guess, if that's still pandemic related. Yeah.
So that working theory is you get 2 years. And the start of the real wave of apartment supply was basically, looking at it.
July 22 seems like when we really peaked. November 21.
So the dark
on permits at least
line here is starts. The lighter line is permits and starts.
Yep.
It does look like May, March 2022 was the start of this plateau of elevated starts, and the end was, you could say November 22 or January 2023 was the end of this elevated period, and from then it kind of went down and down and down.
Yeah.
So what this could mean then, going with a calculation, this past March could be the supply peak. I think it's probably going to be spread across the next few months. However, it's going to take the better part of a year for the apartment market to come into balance after this increase in apartment projects. It does provide a clue. Now we have a little bit more specific timing, and it's interesting that. It's going to be interesting to see how sharp the drop is when it does start to drop, because those numbers, looking at that fall off gets pretty rapid, and it is still continuing.
Yeah. I don't think it'll be as sharp and it'll be as noticeable as just over time, because obviously completion dates get spread out all over the place, and then it's also you're starting to absorb those units, get the apartments actually leased up. So I mean, it's going to be a process, but but it looks like we're really going to be out of the woods, at least by 2026 ish. Is what.
Now that is a good point. Yeah, there's a starts at 2 years, and then that would be another good thing to calculate.
9 months, 12 months to lease up.
Yeah. So at what point does this new apartment really start to have an effect on rent growth? Is it immediate, and how much?
But it also depends on where the rent, what rent levels it gets, it comes out at. If there's a lot of recovery and occupancies are tight, they're going to push rents. But if it's a very soft market, like it most likely will be over the next year or so, 2 years. They're not going to be that aggressive on rents. They're going to try to get leased up because the carrying cost is more expensive than the delta. Or not in some cases. But they're going to try to get leased up to get stabilized so they can refi or sell the asset.
Okay. Well, and what we're talking about here, is trying to predict the future. But really, what the article in RealPage is about how right now permits and starts are down significantly since the past since a year ago. Starts year over year are down by about 43.7%, and permits are down 22%. So that that's going to come. There is going to be a reduction in apartment construction. I don't know if starts are going to continue to go down. But the reason why they're going down is the same reason why they went up before, partly. Interest rates are high. Interest rates were low then. And the reason why those starts started tapering in January 2023 was because that's when the interest rate increases are really starting to bite.
Yeah, I believe it.
And otherwise, you feel like the demand would be there, and they probably would continue to build. I'm not saying that that they wouldn't react to the slightly lower rent growth that we have, kind of rent stagnation. But I think they would continue to build if interest rates were better.
There are many projects that I know of that were put on hold because of rates, of just like, hey, we got to wait because the deal doesn't pencil right now. No, there's a lot that are.
It is interesting to think of what that alternative would have been. If the economy was a little bit different, that we could be the rent growth picture would be a whole lot different, and it really could be the difference between stagnant to really freezing cold rent growth.
Yeah, no, good point. Now, Matt, a piece from Cushman and Wakefield: top trends in the multifamily market. Occupancies are holding up despite record delivery. So even despite all of the supply coming online, 40-year peak in apartment building.
This is a big part of the positive.
It looks like that things are actually doing pretty well in terms of.
It's definitely a counterpoint, a more positive take on the multifamily market compared to apartment lists. I don't think apartment lists was like wholly bad, but this one is, and maybe it's because of who their audience is, but it's definitely more optimistic.
And this data, man, I believe is coming from Cushman Wakefield's property management arm.
Yeah. They're using their own exactly. It's data that they have themselves. It's less like publicly available data when if you're going to compare it with Real Pages permits and starts, that's publicly available data. But again, what they say is we've got a lot of apartments that were built, and occupancy actually within their portfolio, occupancy slightly ticked up. If we are, occupancy is holding up despite record deliveries.
Yeah.
So
we're seeing that in our portfolio too.
Man, it is coming up.
They're holding up. I mean, there were some more moves. There was some more softness last year, but in the last month and a half, 2 months, we've seen more or less some take up, which you should see seasonally. Again, leasing season started. Yeah.
That's just the little upshot that I wanted to highlight here. There are other aspects, other things that they kind of dig into in the report, but I wanted to use that as a little bit of a counterpoint to the apartment list report. And there are other numbers, like I said, wage growth and other factors that make it almost overdetermined how apartments are going to do in the future.
Predestined.
If you're able if you're able to kind of weather this bumpiness this year.
Just another stat from their portfolio from Cushman & Wakefield. Their trade outs are improving entering peak leasing season. So these are their new leases. Somebody is leaving, they didn't renew, they signed a new lease, and they're seeing some positive trends, of increases where their renewal rates, they're kind of bringing them back in line, but they've actually started pushing up on their new leases. So again, that's something we would expect to see. I guess if we saw the opposite, it would be really bad news. But it's good enough. It's good enough news that that we're seeing somewhat normal seasonal behavior, other than the print from Apartment List of showing slightly less growth in April than we saw in March of this year. So now from Institutional Property Advisors, Consumer Resilience offers benefits and drawbacks for commercial real estate. Benefits and drawbacks. What's the takeaway here?
So here's another. I just wanted to add another counterpoint to maybe any cynicism about where the multifamily market is right now, because I want to be realistic, but plenty of reasons to think that JPOW is going to keep rates high, obviously. But we're looking at a situation that could be more favorable for the apartment market. than the economy as a whole. Maybe there are pressures, especially inflation pressures, that could redound to the benefit of the multifamily market that may not be as great for the overall economy. I mentioned again wage growth. This specifically links it to multifamily and retail asset performance, writing that the first quarter was the best opening period. That was the best opening period for job creation outside of the pandemic rebound since 2012. Man, it started off strong there. The best opening period to the best since the pandemic rebound and 2012. But I'll take the positive news where I can get it. It does seem like the strength of the job market is decelerating, like I mentioned before, but it is still in a good place. I'm repeating myself. You can read this as approaching this kind of equilibrium and norm, or if you fall into the opinion that it's going to be runaway inflation, maybe you see this as a trend towards doom. I don't know. I don't think it's going towards doom, but that's just my opinion.
No, Matt, it's not doom. Don't worry.
I know.
We'll be okay.
Yeah.
All is good.
They say a record 5.5 million new business applications were filed last year, which is another positive sign. I think that there's reasons to think that it's, I'm just waiting for the black swan. So once that happens,
just be ready.
There's some clarity. Maybe that's why doomsayers are around, is because it's always going to happen at some point, and it's comforting to know at least this for certain.
It's like you're going and playing the slot machine. You keep pulling. Like no one remembers all of the polls that didn't hit. It's the one that you do hit on that everybody remembers, and they're just hoping they get the hit.
Yeah.
I mean, you get the V1, and then you're like, this is the guy that predicted. Whatever.
Well, I was talking with a coworker earlier.
Who was it?
It was us. It was Addison, and he was talking about, there's an investor that called the housing crisis, and ever since then he's been, here's another one coming. Here's another one coming. Yeah. It's like, take your win, and go home. It's
exactly.
Okay.
Well, what's the chance that you're going to get another one right?
Yeah.
Well, it's like the Michael Berry. Like everyone's like,
that's what he was talking about. Yeah.
Because it's like, what did Michael Berry do? And it's like, you think? I mean, like, he's smart guy, but like. The probability that you call like two major, because it's like no one can really call it, you know.
Yeah.
So
we did it. You did it. You're great. You don't have to do it again.
Just relax and buy, trade your water futures, or I thought that's what you're supposed to be doing. Yeah. Anyway, so Matt, last piece, which is again just some data points. This is from the Pension Real Estate Association, and they put together a document with all types of, it's just stats after graph data, and we're going to be sprinkling this into the gray report here and there and pulling pieces out. But just wanted to take a look at some cap rates and get everybody a snapshot of, according to, this is MSCI data, man.
Yeah.
Safe. So we look at this data. This will probably not be the first time you've seen this. And again, so this is cap rate data. U.S. core properties over 2.5 million. This is updated on April 17th, so pretty fresh off the printer. This looks at cap rates from 2001 to 2023. Now, again, this is just general United States U.S. core properties. They've broken it down from all properties to office, industrials, retail, and apartments. So not even luxury, not A-class, B-class, suburban, urban. It's just some pretty broad numbers, Matt. And so again, like the actual number is, to me, less important, sort of the range, but it's more kind of the direction and the how large the moves are.
Yep.
So, in 2001, apartment cap rates were 8.47%. And that is a high cap rate, and we have not seen that since. By the time we were at 2004, they were high sixes. Eventually, we don't see a 5 handle until 2014, when the average cap rate comes in at 5.99%. I would say that all of these, on average, are elevated. From my knowledge of history and recent history, these are all a little bit more elevated. But yeah, in 2014, in this time period, we're only doing like 6 caps, 7 caps all day long. Something in the 5s would be expensive. But according to this, after 2014, nothing was a 6 cap ever again. And basically kept declining, 10, 15, 20 basis points, sometimes less, a year, until we finally, can get to 2020 when it ends the 5 caps and we get into the 4 caps. 4.86 in 2021, 4.74 in 2022, and then interest rates must go up. Everything that we know, we've talked about, and now cap rates in 2023, according to this chart, ended at 5.29. Now, this is a period where, again, this is what's hard. there was so little price discovery. Not a lot of people were selling, but this is where the average, it shot up. Basically 54 basis points, it looks 54. Like. Now, they do have broken out the first 3 months, the first quarter of 2024, which is honestly more interesting to me than the history, because I kind of knew the history. But, basically from, the average of 2023 at 5.29 as of March 2024, according to this, apartment cap rates are 5.68%. That's much higher, Matt. And that's basically, from peak to trough, that's right around 100 basis point swing.
It's crazy. So from 2022,
from 2022, when it was at 4.74, now to 5.68 in 2024. So that's what, 96 basis points? 94 basis points.
That looks about right. And to put this into context.
Yeah, you made this point earlier, Matt.
Yeah. The cap rate change was stronger, has been twice as strong since it was during the Great Recession.
Yeah. But so that kind of stands out a little bit, but let me tell you why that makes sense, though.
Yeah.
So, there was a real estate crash, but it was mostly revolving single-family homes, and it really didn't relate as much to. I mean, interest rates did rise, in the lead up to the Great Financial Crisis. That was part of it, but it wasn't a rise like we've seen today. It wasn't driven by. It wasn't a commercial real estate driven recession. It was much more related to, again, single family homes, the mortgage industry, and then all of the derivative instruments related to that and tied to the rest of the economy. Certainly multifamily and commercial real estate got wrapped into that as there was a lack of liquidity in the market and banks were looking for liquidity and what assets worked, what didn't. But nothing was, if anything, people were losing their homes, they needed a place to live. So the multifamily market, while there was negative rent growth, there definitely during the recession, it was not an easy time, it wasn't a great time. But it wasn't absolutely horrible for the multifamily industry. As long as you had decent financing, you didn't get way too over your skis. There weren't stories of everybody losing their apartment buildings. Some people did lose their apartments. They did get foreclosed.
And I think the rent growth numbers actually bear that out as well.
Yeah, but it was a little bit of a dip for about a year, and then it started rising again. But we didn't have. It wasn't an absolute interest rate shock. I mean, we didn't have the Fed funds rate increase by 500 some points. So it's affecting different parts of the economy differently, and obviously commercial real estate is highly correlated in many ways to interest rates, very much kind of tied in to where values are relative to cap rates and financing rates.
I wonder then too, because they have some graphs of unlevered returns for different property types, and they all took a dip. They all were negative in 2023. And even more interesting, at least to me, was the spread, the cap rate spread. It is tight still, but it was flipped in why there is some point if you're approaching 2001 and stuff where interest rates are higher than cap rates, and I don't know how does that even make sense. So people aren't using
2001.
Or around whatever the beginning of this chart was, there's clearly a period where interest rates become so much higher than cap rates that it doesn't even make sense, and it must be the market. So it's a little bit later in the report. It must be the market just operated under different rules. Keep going. See, there's the returns, and you can see that apartment returns were the only ones that really seemed to be not negative of all the different asset types. But this must be. Oh, there it is. Okay, yeah. This is annualized cap rate treasury spread. This is not, this is a representation of the market. It's just an example of.
Well, it looks like it was negative 85.
Okay, it was 85.
It was
right.
85
yeah.
to 86-ish, and then also negative.
Sorry, not 2001.
Yeah, so it was in the 80s there were periods that it was negative. That makes more sense because interest rates were 10+%, and cap rates were elevated, but they weren't that elevated.
Yeah, it's just
So the 10-year treasury was 10-11%, and cap rates were well, they didn't even have them here. I guess they have them around like the 8% mark or so.
So for about like 5 to 7 years, I don't understand how maybe deals were just funded not really with interest rates.
That's why there's a big fall off on deals that were. There's a lot of construction in the 70s and the mid or early 80s.
Okay.
You see a lot of like 82, 83, 84, maybe some 86. You don't see a lot of 87 built property. You see some.
Oh, interesting.
You don't see a lot of 1990. You see some. You don't see a lot of 1991.
Really
you see,
interesting.
Like they exist.
Yeah.
But there's a big drop off in development.
Wow. Okay. Super interesting. Do you think we're heading to that today because of the supply wave?
Well, there are similarities. I mean, again, we're talking about where this 40-year peak. I mean, we're going back to this period just before this time period.
Yeah.
When interest rates were relatively high, but they weren't necessarily. Well, yeah, they weren't necessarily. They were lower than they were in like that mid 80s. We're talking about earlier 80s.
Where half
and the
the
70s.
interest rates, half where 10-year treasury is.
But there was a lot of growth in that period. As well, So.
I think that it kind of rhymes. I think that the amplitude of either is probably different too, because when people are saying, say, record-breaking apartment supply, it's always an asterisk because there was so much construction during the 70s. It's just that's outside a lot of people's lifetimes.
Well, yeah, and exactly. As we're talking about this, I'm like, well, I was not alive in the 70s, and I'm not, and I'm pretty familiar with what was going on in the market, and I've talked to a lot of owners and multifamily folks that were very active in the 70s and 80s, but I'm not an expert in it.
Yeah, well, I mean, we are following a period of inflation, just like the 80s. We are following a period of high building, just like the 80s, and we are following a period, and so, and we're also following a period of overbuilding. So,
yeah, so we're gonna get into the 90s now, and everything will be.
That's a good point.
Good. It'll just be like the 90s.
Yeah, we all like the 90s. That's a good point.
Yeah, just be like a Portlandia episode.
Yeah. All right, I kind of like that.
We're gonna have it's gonna be Star Trek Next Gen. It's gonna be utopian. Everything's fine. We figured out the world.
People are a little more ironic.
We've defeated communism.
That's nice.
Fine. Yeah, I don't see that coming. And then there'd be quite of a turn of events.
Yeah.
Israel and Palestine have, everyone's good. Everyone's good in the Middle East.
Yeah.
Ukraine, Russia, United States, we're all good.
Yeah.
Donald Trump, Joe Biden, they're good. We're all good.
I think
Marjorie Taylor Greene is good.
Yeah. Well, I don't have no complaints to anyone. I think they're all great, really. We're working hard, and God bless them.
That's what Matt says. That's not the opinion of this channel.
To circle it back to a more comforting kind of
who else is great?
Comments on
anybody else great?
Yeah. All right. Yeah, that's true. Not everyone can be as great as Spencer and I.
You got to withhold. You got to withhold the greats.
Yeah.
All right, it's fine.
Yeah, that's true.
We digress, Matt.
Yeah.
These folks have more important things to do. But the one important thing that they could do is subscribe to the Great Capital YouTube channel so they can get my report sent to their inbox all the time. You have to hit the bell icon to make sure that happens. But if you hit all the buttons that you can see besides the downward thumb, thumbs down, do all the buttons.
Maybe make a comment.
Please make a comment. We'll most likely respond to you. We do have a new project at Great Capital. It's a new deal. It's placed under LOI. Can't give too much information out on it right now, other than it is really exciting. It's in our backyard.
The atmosphere here is electric.
There you go. It is.
It's that weird period of time that is unique to, I think, this multifamily syndication business where we get really excited about a deal, but we can't tell anybody yet for legal reasons. And then, the things get signed.
It's more cultural reasons.
Yeah, well, some reason
legal.
why. It's like you get a present and you can't open it, do not open until Christmas or something.
Yeah, there's no there's certainly no law, and there's no, we're not under contractual obligation to not say anything, but it's best practices not to say until the deal's ready to go.
Yeah,
it's done.
That's true. It could get messy
because then someone's like, "Oh, you guys are doing that deal? Well, maybe we'll try to get it."
Yeah. Okay. All right. I'll respect the norms.
Yeah. Some of them are there for a reason.
Yeah.
But I mention all of that saying that if you've watched this whole episode, again, thank you for taking the time to watch this episode of The Gray Report. But hop on over to the Gray Capital website, graycapitalllc.com, and make sure you're signed up for our investor portal. If you're signed up to the portal, you're going to get exclusive first access and dibs on the new opportunity. It's going to be open to accredited investors only, so make sure you are an accredited investor if you're going to start looking at the project. But as soon as we roll out more information, which will hopefully be in the next probably 10 days or so-ish, schedule a meeting with us, get all your questions answered. We're going to have webinars, we're going to have videos, live chats. We're going to have property tours since it's so close to our office, Matt. I can't give away too much, but it's air, land, sea, the whole kit and caboodle. It's really exciting. So get in touch with us to learn more. But subscribe to the Gray Capital YouTube channel and you'll get all the information too. So have a good one. Talk soon.